Palantir completely crushed Q2 2026 earnings, just beating Wall Street consensus across the board. I mean, revenue came in at $1.935 billion.
Right, which is a massive 93% year-over-year increase.
Exactly. Completely blowing past the consensus estimates of $1.810 billion. And adjusted EPS landed at $0.41, decisively beating the consensus of $0.34.
Yeah, a huge beat there, too.
And on top of that, management raised full-year 2026 revenue guidance to a range between $8.150 billion and $8.158 billion.
Up from that previous $7.65 billion projection.
Right, which signals an expected 82% year-over-year growth rate. And shares, obviously, popped on the news, closing up 2.1% at $125.65 in the regular session ahead of the release.
Yeah, it's been a wild ride, but we are breaking down this exact Q2 2026 Palantir earnings report for you, the retail investor.
The goal here is to just, strip out the market noise and look strictly at the underlying mechanics of this quarter. Because those headline numbers are historic. I mean, you rarely see a company operating at a multi-billion-dollar run rate posting 93% top-line growth.
You really don't. And we're going to analyze the segment performance driving these massive beats, the margin profile, the management commentary, and critically, those valuation risks you need to be aware of.
Right, because a top-line revenue beat doesn't just happen in a vacuum. To understand exactly why that number skewed so violently to the upside, you really have to look at the specific engine driving.
And right now, that engine is unequivocally the U.S. commercial market.
Absolutely. When you pull apart the segment data, U.S. commercial revenue just exploded by 149% year over year.
Wow.
Yeah, and 28% quarter over quarter, hitting $764 million.
Meanwhile, the U.S. government revenue grew 90% year over year to $809 million.
Which brings the total global commercial revenue to $945 million, up 110% year over year.
So the velocity of that U.S. commercial growth is really the focal point of this entire earnings report. And the underlying mechanism driving that 149% surge is Palantir's AIP.
Their artificial intelligence platform.
Exactly. For the past year, the whole narrative around Palantir has been about these AIP bootcamps. They were getting companies in the door, running these short-term pilot programs. And what this Q2 report proves is that those proof-of-concept pilots are now rapidly converting into massive full production environments. I mean, the U.S. commercial customer count surged 35% year over year to 653 clients.
That's a huge jump in headcount.
It is, but the most vital metric to watch here isn't even the headcount. It is the total contract value, or TCV, generated by this segment. The U.S. commercial TCV hit an astonishing $2.132 billion this quarter.
$2.1 billion. That number is really the anchor for everything else in this report.
Yeah, it changes the whole conversation.
Because in traditional enterprise software, a pilot program is basically a company just, kicking the tires. They spend a few $1,000s, maybe give a handful of employees access to a sandbox environment, and just see if the tools actually work.
Right, a very low-stakes trial.
Exactly. But TCV represents committed future spending. It means these companies aren't just testing the software anymore. They are signing binding multi-year contracts.
Which is a massive shift.
It is. To put it in perspective, it's like traditional software sales is like handing a company a box of airplane parts and an instruction manual and hoping they figure it out over an 18-month integration process.
Good luck. Right.
Yeah. But Palantir's bootcamp model is like having their engineers build the plane on your runway, put your data in the cockpit, and fly you in it by Friday. Once a chief information officer sees that their proprietary data is instantly generating ROI, they aren't going back to the box of parts.
No, they're buying the whole fleet.
Exactly. They buy the whole plane. But I have to ask, why is this conversion velocity, this speed from pilot to production, such a critical leading indicator for the stock right now?
Well, because in the SaaS business model, conversion velocity dictates the durability of your future revenue pipeline. When a client signs a contract that contributes to that $2 billion TCV, Palantir's software has officially become embedded into their daily operational architecture.
It's mission-critical infrastructure at that point.
Precisely. High conversion velocity means the traditional grueling 12 to 18-month sales cycle has been radically compressed. The value proposition is so immediate that enterprise leaders are just completely bypassing their usual multi-year procurement delays and authorizing massive capital expenditures right now.
So they're just skipping the red tape.
Exactly.
And that 35% jump in customer acquisition perfectly explains the top-line revenue explosion.
Yeah.
But usually, acquiring enterprise customers at that breakneck speed just completely torches a company's profit margins.
Oh, absolutely. Historically, yes.
Right. Usually, a SaaS company growing this fast is burning hundreds of millions of dollars on massive sales teams, marketing blitzes, integration consultants to onboard all those new clients.
They're just bleeding cash to grow.
Exactly. Yet, Palantir's profitability metrics are somehow defying standard SaaS gravity. I mean, their GAAP operating margin hit 47%, which is $912 million.
Unbelievable.
And their adjusted operating margin reached a staggering 62%, coming in at $1.194 billion. Plus, the GAAP net margin was 55%.
Those numbers are just essentially unheard of in legacy enterprise software.
Right. So how is it mathematically possible for them to scale customer acquisition by 35% while somehow expanding operating margins to 62%?
It fundamentally breaks the traditional SaaS economic model, and that's why these numbers are almost difficult for traditional analysts to reconcile.
It just doesn't compute for them.
Right. The mechanism behind this incredible operating leverage is exactly what we were just talking about, the bootcamp strategy.
I don't guess so.
Well, traditional enterprise software requires armies of account executives flying around the country, buying steak dinners, fighting through endless layers of corporate bureaucracy.
Which means the customer acquisition cost, the key I, is incredibly high.
Sky high. But Palantir has essentially eliminated the traditional sales team. They invite a client's engineers to a boot camp, they build a live AI use case on the client's actual data over a few days, and the product essentially sells itself.
Wow. So the customer acquisition cost just plummets.
Exactly. Every new dollar of revenue is costing them significantly less to acquire. And you can see their balance sheet reflects that efficiency. They generated $1.220 billion in adjusted free cash flow this quarter.
A 63% margin.
Yeah. And they're sitting on a fortress of liquidity. They have $9.2 billion in cash and short-term U.S. Treasuries with virtually no debt.
No debt. That's insane.
It is, and this brings us to a metric that really puts Palantir's current operational efficiency into perspective, which is the Rule of 40.
Oh, right. Let's talk about the Rule of 40.
For you listening, if you evaluate SaaS companies, the Rule of 40 is sort of the ultimate benchmark for balancing growth and profitability. You simply take the company's revenue growth rate and add its profit margin.
Right. And if that combined number is over 40%, the company is considered an elite, highly healthy software business.
Exactly. To give you an idea, a very successful hypergrowth tech company might hit a score of 50% or maybe 60%.
Okay.
In this Q2 report, Palantir's Rule of 40 score climbed to an unbelievable 155%.
Wait, 155%? That seems like a typo in a financial document.
I know, it really does.
But beyond just the lowered customer acquisition costs from the boot camps, there has to be a technical reason they can deploy the software this cheaply. I mean, you still have to integrate the platform across 653 different companies, all with completely different legacy data systems.
Yeah, you do. And the technical secret to that margin expansion is standardization.
Standardization.
Yeah, in the early days of Palantir, every deployment was basically a custom consulting job. They had to send out engineers to manually wire everything together.
Very labor intensive.
Very. But what they have done over the last 2 years is standardize their deployment templates. So as they expand across specific sectors, say major hospital networks or global logistics firms, they create specific AI orchestration templates for those industries.
Oh, I see. So when they sign the next hospital or the next shipping company, they don't have to build the architecture from scratch.
Precisely. They just deploy the existing template. So the cost to deploy the software for the next customer drops dramatically.
So not only is the cost to acquire the customer lower, the cost to serve the customer is lower too.
Exactly. That means almost all of the new revenue from that $2 billion pipeline drops straight to the bottom line.
Wow. Okay, so to understand how they achieve this specific product market fit at exactly the right time, we really have to look at management's commentary regarding the broader macro environment.
Yeah, CEO Alex Karp's earnings statement was very specific. He heavily emphasized one phrase: demand for AI sovereignty has now been unleashed.
AI sovereignty. That concept is the core thesis of their current momentum, right? Palantir is capitalizing on the very real existential fears that enterprise executives have regarding data leakage.
Absolutely. Every major corporation in the world right now knows they need to leverage large language models to stay competitive.
Sure, you have to.
They want the ability to query their massive data lakes and have an AI instantly optimize their supply chains or, predict maintenance
But
failures.
they are terrified of public AI models.
Right. If a multinational logistics company plugs their proprietary routing algorithms and customer manifests into a public LLM, there is a legitimate fear that their data will be absorbed into the model's training parameters.
And then eventually surface for their competitors.
Exactly. And your proprietary data is your only competitive moat.
So Palantir uses something they call their ontology framework to solve this. Think of the ontology as highly secure universal translator for a company's messy, siloed data. It takes the data from the HR department, the warehouse sensors, the legacy ERP system, and organizes it into a digital twin of the physical business. Then it allows a company to plug an AI model into that digital twin safely.
It's a great setup.
Yeah, it's like hiring a master chef to optimize your restaurant, but ensuring they are legally and physically prevented from ever writing down your secret family recipe or, using it at their next job.
That's a perfect way to look at it.
You get the world-class expertise of the AI, but you maintain absolute sovereignty over your secret sauce. The AI can read the data to give you answers, but it cannot learn from the data to train future models.
And that guarantee of data sovereignty is what separates Palantir from companies just selling access to an API wrapper. And this concept of absolute data control extends even more heavily into their government and defense work.
Which is massive.
Right. Looking at the U.S. government segment, which, as we noted, grew 90% year over year to $809 million, the earnings report explicitly points to the global geopolitical climate as a macro driver.
Right. And I should note here, the financial documents and management commentary cite ongoing defense contracts, the current war in the Middle East, and expanding Department of Homeland Security spending as direct catalysts for this revenue acceleration.
Yes, and we need to be very clear for you listening, as analysts, we are impartially reporting the geopolitical catalysts cited in these earnings documents.
Absolutely. We are absolutely not endorsing any political viewpoints or military actions here. We're just strictly conveying what management is reporting in the source material.
Strictly looking at the numbers.
Yeah.
And analytically speaking, escalating global tensions act as a massive macro tailwind for Palantir's government segment.
Yeah, because when nation-states are forced to modernize their military and intelligence apparatuses, they prioritize secure, multi-environment architectures.
Like sovereign clouds that can operate even when disconnected from the broader internet.
Exactly. And Palantir's platforms were originally forged in the intelligence community, so their architecture is uniquely positioned to win these highly regulated, time-sensitive deployments.
Right. That $809 million in U.S. government revenue reflects a rapid formalization of operating models where data control isn't just about protecting profit margins.
No, it is literally a matter of national security.
Exactly. But, the convergence of this macro environment, the demand for AI sovereignty, and Palantir's flawless execution, it makes for an incredibly compelling growth narrative.
It does.
But every trade, no matter how strong the underlying business, carries downside risk. We need to unpack the bear case for retail investors because there are structural threats to this stock that aren't immediately obvious when you just look at the top-line beats.
Well, the most glaring risk for anyone looking at this stock today is the valuation treadmill. I mean, at a roughly $295 billion market cap, with the stock price hovering around $123, Palantir is trading at approximately 38.5 times its full year 2026 revenue guidance.
Yeah, that's steep.
And even more staggering, it is trading at almost 69 times its adjusted free cash flow. But let me play devil's advocate here. Wait, a 38.5x multiple on future revenue. If Palantir has beaten earnings 8 quarters in a row and just raised full-year guidance to over $8.15 billion, why does that multiple actually matter? Isn't growth just growth? If the company is demonstrably dominating its sector, shouldn't investors just accept that growth commands a premium?
Well, it matters because of the mathematical reality of multiple compression. When you buy a stock at 38.5 times its future sales, you are not paying for the company as it exists today.
You're paying for the future.
You are paying for a completely flawless execution of Palantir's business model 3, 4, or even 5 years into the future. That price assumes the 82% growth rate continues unimpeded.
So this is what the market calls priced in perfection.
Exactly. The risk isn't necessarily that Palantir is a bad company. The risk is that they are a great company that slightly underperforms a monumental expectation.
Meaning if they report 50% growth next year instead of 80% growth, I mean, 50% is still an incredible achievement for any software company.
Phenomenal, yeah.
But because the stock was priced for 80%, the market suddenly re-rates the company. Wall Street decides they're only willing to pay 15 times revenue instead of 38 times revenue.
Right.
And when that multiple compresses, the stock price absolutely craters, even though the underlying business is still generating record profits.
Exactly. That is how a stock can fall 40% from its peak despite consecutive earnings beats. And looking at the underlying report, there are fundamental factors that could trigger that slowdown.
What kind of factors?
Well, the sources note potential softness in the European commercial market. European nations have stricter data sovereignty laws, and some allied nations are actively exploring alternative, localized providers.
Right, to avoid over-reliance on a U.S.-based defense contractor.
Precisely. And if European commercial adoption stalls, it puts more pressure on the U.S. market to carry that massive valuation.
There is also the inherent lumpiness of large government contracts to consider, right? I mean, a massive $500 million government deal might be verbally agreed upon, but its actual signing can be delayed by a continuing resolution in Congress, an election cycle, or just a shift in defense budgets.
Yes, the timing is very unpredictable.
So if a mega contract gets pushed from Q3 to Q4, the company might miss their quarterly revenue targets.
And for a stock price for perfection, a single missed quarter due to a bureaucratic delay can trigger a violent sell-off.
So as an investor, you constantly have to monitor if their operational execution can continue to outrun their soaring valuation.
It requires extreme vigilance. You are betting that the transition from pilot to production continues to accelerate, and that the macro environment continues to force enterprises to prioritize data sovereignty over cheaper, off-the-shelf software solutions.
Yeah. And looking at the broader landscape, legacy enterprise software providers are currently facing massive headwinds. I mean, over the last year, IT budgets have been aggressively shifted away from traditional software subscriptions and poured almost entirely into AI hardware.
Right, the GPUs, the servers, the massive data centers required to train these models.
Exactly. But I want you to think about this. What happens to Palantir's total addressable market when that multi-trillion-dollar hardware infrastructure is finally built?
That's a real question.
Once the data centers are running, the enterprise world will inevitably redirect those massive budgets back toward functional software layers like Palantir's ontology to actually use the computing power they just bought.
Yeah, it's the transition from building the engine to finally driving the car.
And whoever owns the dashboard is going to capture an immense amount of value. That's the dynamic you need to be watching as this sector matures.
Because the companies that survive the valuation treadmill will be the ones that prove their software is the essential layer between the raw compute power and the actual economic output of the business.
Absolutely. Well, make sure you follow the show for your daily earnings coverage where we break down the numbers and the mechanics that actually matter to your portfolio.